Everyone looks like a genius in a rising market, but how can you protect your real estate investment when the market shifts? Whether you're a passive investor or a general partner, you're going to want to stick around because today we're going to be breaking down the 6 ways to protect your investment during an economic downturn. John, it's great to be here with you.
Wonderful to be here, Mark. The bottom line is there's always a cycle, that we're in the market, right? And so sometimes it's an up cycle, sometimes it's a down, and sometimes there's events that nobody can predict that come your way. So these are lessons you can really apply at any time, but very important during a downturn. So looking forward to diving in.
Yeah, like real estate is sexy when it's going up and when it's going down. Like as of now, in the beginning of 2025, real estate is not sexy when you're talking with your family. It's interesting, John, when the market goes up by 30%, it's like everybody thinks it's the best thing since sliced bread. But when the market drops by 25%, like we're getting some deals now at like 30% discounts, it's it's like real estate. Yeah, it's good, but it's not as, people aren't jumping on the wagon as fast in today's market because they saw that, pricing has come down. But this is exactly when you want to be able to get in and buy. The key here, and this is what we're going to be breaking down today, is how do you operate when you are at, say, a top of the market and then the market shifts on you? How do you protect yourself from that shift so that you can still hold on to your properties through the downturn? And then how do you continue to structure your deals at the bottom of the market as well to be able to ensure that, whether the market continues for a number of years the way that it is, or maybe it drops further, or maybe it goes up, you're going to be protected. And so we're going to be talking about the 6 ways to be able to protect it so you're getting ahead of it so you don't get into a oops, and we didn't plan for that because we're talking about tens of millions of dollars here. It's not one of those things that you get a redo in a lot of cases.
That's absolutely right. And, I think if you apply these strategies and then you apply the wisdom, actually, it was Will Rogers, the famous actor, quite successful, invested a lot of his income into real estate. And he said, don't wait to buy real estate and wait. So when you have a really great strategy and you have protection in place to monitor and to sort of come through any potential downturns, it's one of the best investments out there, right? So it's just all about staying diligent. And it's like we always say, like, it's not so much a bad property that creates the a loss in real estate, it's bad assumptions, right? And it's a bad process. So, yeah, exciting topic to dive into today. I think for us, Mark, it's worth mentioning at Faris Capital Partners, we have a very conservative underwriting approach. Our mindset is just built to last. And so, whatever we buy, we want to make sure that we're applying these 6 lessons, regardless of the market, but more particular when you're in a more challenged market. So,
Mm.
number one, right, buying cash flow properties on day one. I think that's one of the simplest concepts. If you can just get to that place, right? And on previous podcasts, we talked about, one of the things newer investors do is they chase those higher cap rate deals because a higher cap rate could potentially mean a better return, but it also comes with a lot more risk. So at the end of the day, we want to buy at a good cap rate, right? We want to buy the property at the lowest amount that we can negotiate, but we're also not chasing opportunistic deals that may be in rougher areas or areas that have challenges that could lead to a bad investment for ourselves and our investors. So when a property's cash flowing on day one, it's already successful. And when we can see that upside and apply our value add strategy to it and even grow that cash flow, that's exactly what we want to do. But when it cash flows on day one, that's the number one thing you can do to protect yourself and your investment during any market.
Hmm. Well, it gives you a lot of leeway, right? Like if a property is carrying itself, just think of buying a business. If it's generating money from day one, it's like you could do absolutely nothing and you're going to be fine.
Hmm.
And, that's where with new development, you got to make sure that the team and your projections are bang on because if you get it wrong, or if say you don't get the approval you wanted and you have to carry it for an extra 6 months, well, you have all that infrastructure, you have all that land costs, you got a big nut that you're having to carry, and you still have to make payments on that with zero coming in. I've heard it once before that vacant land and building eats 3 meals a day, and it does because, it's coming out of pocket. And so if you get an assumption wrong on a cash flowing property compared to let's just say a new development or a vacant or a heavy lift that has a big repositioning in that and it's not making money from day one, you could have more margin there for error, so to speak, in cash flowing properties. Whereas with new development or any sort of heavy repositioning standpoint, you have to get it right. And so that's where for us in our very first deal, we had partnered with another group, and it was a heavy, we'll say heavy lift, hotel to multifamily, and it's taken longer than expected. And so the challenge there is that there's no income coming in, so it's continuing to say cost more. Whereas all the properties that we're buying today, it's like they're already cash flowing like 5% is what they're doing on day one on your investment, so cash on cash returns. And then every year that goes by, as we're investing into the property, increasing net operating income by increasing rents and lowering operational costs, I mean, it just continues to get better and better and better. And so we'll just say you just have that one rule, John.
Yeah.
Buy for cash flow. Robert Kiyosaki was right. And where you feel it the most is in a downturn. When the market is going up and you're investing for appreciation, maybe you're buying a new condo and you're hoping it's going to go up in value. When it's appreciating, you look like $1 million. You look like you're a genius. But in, we'll say, the Toronto market right now, the condo market has dropped significantly and they've way overbuilt there. And so now you have buyers brand new. So anybody that had bought a new condo a couple of years ago, now they're coming up and they need to close. So there's like a 2-year build out, and now they have to close, and now they're underwater on that, and they have to actually bring an extra couple $100,000 to the table than what they had expected because interest rates have doubled. And so in some cases they don't even qualify, so they're in trouble as well. So buying for cash flow, there's real genius in doing that and real protection, especially in a shifting market.
Yeah, that's right. It's why it's one of our golden rules. We will never buy a deal that needs rent growth or refinancing to make sense. It should make sense on day one, and that protects the downside for ourselves and our investors. That stabilized cash flow, it's really just oxygen, right? It's breathing room, as you work on your value add plan there. So, another one of our golden rules, which is number two on our top six ways to protect your investment during a downturn, is to lock in fixed rate debt. And you just illustrated a great example of that. Rates in some cases doubled and tripled from, say, early 2020 to today. And so those that had floating rate debt, in fact, a lot of operators in our business, were buying on floating rate debt in 2020 and 2021. And now those deals are very challenged and they're behind on their mortgage, or at very minimum, they don't have the cash flow necessary to do their value add plan. So the deal is sort of stalled out. So when you have floating rate debt, make sure there's a cap rate in place. But in our world, we just get fixed rate. That's just the easiest, simplest. And if the deal doesn't work with fixed rate debt, we just simply don't do it. It's also about the predictability. We know exactly what to expect in terms of our payments. So we can map out in our pro forma the full term of the loan and the full term of our ownership and know exactly what our expenses are going to be outside of maybe fluctuations in pricing with utilities or maybe construction material. But there again, that's where you put in the contingency, right? And due to the tariffs that have recently been announced, and it's still fluctuating, Mark, as you know, it's changing every day. But 3 years ago, 2 years ago, we were budgeting $1,200 a door. Now we're budgeting like $1,600 a door. So we're putting in that work to make sure that all that is there and is accounted for. But when you know what your payment is, and that's your biggest expense outside of taxes and insurance, like knowing what that is allows you to really map out your full term of ownership. And assuming you hit your business plan and you hit those targets, you know exactly what this deal is going to look like. So, fixed rate debt is super critical to protect yourself in a downturn.
Mhm. I mean, especially with what the market had gone through with, nobody thought that the rates would increase as fast as they did. And so, a number of years ago, it's like I still remember a lot of operators saying, "Oh, like you get variable rate, adjustable rate more loans, you cash flow way better. It makes a lot of sense." It's like right now, after seeing all that, very like we had front row seats, like we saw that,
Yeah.
and so this is where for us, just having that golden rule about fixed debt, it is very calming, very to know that those payments are the same each and every month. And you know what? The deal makes sense when we go in and we submit our offer. The deal makes sense on fixed debt. And, that's where if the rates do go down, that's okay by us. If it goes down and we say we're paying a higher interest rate because we've locked in our debt, is no problem. For us, it's like the deal is still penciling out. It still makes sense. We're still hitting our distributions. And, the good news is as rates come down and we go to exit, there'll be a prepayment penalty on that, but we factor that into our exits. After 3 years, we factor that in. But if interest rates go down, we're going to be winning on the backside because the valuation of the property based on lower interest rates, operators will be able to get into that property a lot easier, which will increase the value of the price. So we win either way
That's right.
if interest rates do come down. But having that insurance, knowing that we can put our head on our pillows at the end of the day, knowing that we're not going to get a oops, we're in a deal now, and now we're going to call our investors and saying, oh, we can't make our overall capital distributions there to our investors. That's just not something that we want to do or won't do moving forward. And we'd rather have that predictable payment standpoint because you never know. I mean, we believe the data is telling us we're hitting a bottom of the market, but we're not going to stake our entire reputation on only that happening. We want to be able to protect no matter what. There could be a black swan event that comes in. Maybe, we've seen pricing drop 20-30% from the peak of the market. But John, I mean, who knows? Maybe it goes another 10 or 20%. Like, I don't think so. But if it did, we're good. And,
Yeah.
we're fine by that.
That's right, 100%. And we've done an episode on our golden rules, and so it's not surprising, as we kind of put this list together, that 3 of the 6 things are our golden rules. Number 3 being maintaining strong cash reserves and having a capex contingency. So capex being your renovation plan, right? So once again, prices fluctuate, so we need to be mindful of that. We have 6 months of principal and interest on our mortgage payments sitting in the bank for a rainy day. We do that because, once again, you just never know what could happen. Now, one of the ways we stress test all of our deals is we look at that break even occupancy, right? So, typically when we're buying a deal, somewhere between 65 and 75% occupancy is break even. So, a deal we're actually set to launch here, probably by the time you're listening to this podcast, it will have launched. It's one of the lowest we've ever seen. And so having that along with those reserves just lets us know that we've got that cash. It keeps us warm at night and gives us a lot of comfort just in case some black swan event occurs, to use your word there. We also add that 10% contingency on the renovation plan, as I mentioned, just because prices sometimes fluctuate, or maybe there's an unexpected expense, an HVAC system breaks that we didn't account for. Now, generally, when we walk the property, Mark, our construction manager is always with us, and we actually walk and check out every compressor. So it's funny, we just toured a deal in Georgia, and I took over 175 photos, mostly of compressors, because I found some that were as new as 2-3 years ago and some that were dating back to the 90s. And so knowing that, we go through and we audit those photos and we look through and we say, okay, we're going to have to budget for at least 45 compressors. May or may not break, but that money's in the bank in case we need it. So, really more than anything, that money could be applied to a lot of different things. So if, for example, we see a wave of new inventory in an area our building's in, now we're looking at permits and we're looking at the pipeline that is predicted to come. But over a 5-year ownership, something could change. Maybe in a year or so, couple new buildings get built, and maybe they're giving out rent concessions, and we have to do the same to stay competitive. We've got that money in the bank. At the end of the day, that cash on hand, I use the term, it's like oxygen, right? But at the end of the day, it allows us to control the timeline. So we're not really worrying about the market so much. We're worrying about just our business plan within our own property because we've got the cash necessary to get through any challenges, or if we have some unexpected expenses come through. So and by the way, when we're raising all that capital, I mean, all that's accounted into the underwriting, so we're still hitting those same return metrics, right? So if we have to spend that money, we're still hitting those returns. But if we don't, then that money just gets distributed back to our investors at closing. So it's something all operators should be thinking about. And if you're thinking about investing with another operator, make sure you're asking questions about their reserves and capex contingency program and how they plan for that.
Next, we are looking at underwriting conservatively. So this is a big one. It's so easy, John, when you're getting into the final numbers. You're you're competing. Majority of these deals, we're either competing, or even if it's an off-market deal, generally the brokers shopping it out to a few different operators. And so there's the odd one that we'll get the only crack in. And in our Charleston portfolio is a good example of that. We got a call on a pretty much on a Friday, and we flew it on a Monday, and we wrapped it up on Tuesday before it hit the open market. Uh, but with that being said, it's easy when you're getting into that final underwriting, when you're like, we're so close. Maybe the seller's expectation is a little higher than ours, and we're just like, how can we do this? And so the good news is that when you are looking at a deal, you got many different levers you can pull. And so that's where I think our underwriting model it's like 20 to 25 different tabs in that. And so it's very elaborate. And so you got your biggest levers that you have is your future exit cap rate. And so this is a big one. And then you have rents. There is how much extra in rent are we going to be able to get after we do the renovations? And then you have your organic rents, and then you have your capex. Now there's the capex. There you have our budget. It's there, but for us, it's like, what is going to be the organic rent growth? And so it's very easy. Instead of doing, say, like 3.5%, it generally what we'll do, it's easy to push it to like 4.5%, and that can change the deal drastically in regards to what your offering price is. And so for us, we're constantly debating and saying, hey, listen, okay, what's CoStar projecting out? And then what do we think is a conservative projection out? And so we want to be able to be conservative there, rather than, okay, we're just going to push the line always. Oh, don't worry, we'll figure that out after. Well, we don't want to be coming back 3 years down the road and say, hey, listen, we are we over projected what those natural conservative that natural appreciation was going to be. And so for us, we're constantly debating, and that's the beauty of having, we have about five of us on the call, John,
Yeah,
uh, five senior leaders there, and we're debating and we're pushing. But if you are not conservative at that point, is very easy to get too aggressive, and now you're overpaying, and then you get behind the eight ball because you have certain projections that you have to hit, that you promise your investors, that you just can't hit anymore because the market's not doing what you thought.
that's right. Yeah, underwriting aggressive rent increases, specifically organically, will get you in trouble. Let's face it, expenses are hard to drive down today. We've gotten fortunate here and there where, for example, when we closed on our Largo deal, originally the insurance was around $1,800 door, and we got a renewal closer to 1,000. So that was a huge win. But what we didn't do is like distribute that cash. We actually kept that in the bank because we anticipate our rate will go up again next year, right? And so we had no issues during the two hurricanes that came through Tampa, and we did a lot of preventative maintenance. The insurance company that rebid in year two saw that, gave us a great rate. But we're not sitting there going, great, we're going to have this rate for the next 4 years. Like, we recognize that it'll probably go back up. But with tariffs, right? Like, we don't expect expenses to meaningfully decrease. So we're budgeting in appropriate expense increases, right? Another factor too, Mark, is like one strategy that could work, especially with, say, maybe the longer hold, like 10-year investments. Today, we typically target a 5-year hold, but is the idea of a refinance event where you can get cash out, get cash back to investors, and continue cash flowing the deal. And that may occur on some of our deals, but we don't try to predict what interest rates will be in 3 to 5 years, right? So if you make that promise to an investor, oh, we'll just refinance in 3 years. What if rates are higher? Now all of a sudden you can't honor that commitment. So just making sure whatever our plans are things that we can control. And so we'll use the best information at the right time to make the best decision. But we're not going to underwrite something that we can't reasonably predict, which is like interest rates, right? There's no way of knowing what interest rates will be in 3 to 5 years. So it's just one of those things that, once again, we talk about, we discuss internally as potential options with these deals, but we don't count on it. When you can't predict it, you cannot count on it. So that's kind of another factor there when it comes to our underwriting. We want to make sure we can absolutely deliver on our business plan.
Well, and I mean, it's a good example. The 66 unit we just took down, John.
Yeah.
Treasuries, I mean, they're fluctuating every day. And so right now in our underwriting, we went in with our projections, and we're extremely conservative with what that rate was. And so if it does come down, was what we're expecting, but if it does, it only makes the deal good. We don't go in and we didn't underwrite the deal being super aggressive, as in, making we're basically making sure that we're locking it in as what it is today, but it might actually jump up before we actually lock that rate in. And so for us, being conservative going into this deal is really important. So we don't close on it like, oh, by the way, investors, we actually locked in at a higher rate, and the returns aren't there anymore. So that's
Yeah.
a really good example of, there can be long-term thinking, but then also short-term thinking when you're actually going in to a deal. Because once you lock in, you really make your money when you go in and buy.
Yeah.
And then where you make your true money, that's like your beginning money. And that is true on how you operate the property. But when you go in and you make your assumptions, you said it well at the beginning, there's no bad properties, they're just bad assumptions, is
Yeah.
what. And I that is so true. That's so applicable in all properties. I mean, just think of it, even a tear down. If you had the assumption that rather than you doing the renovation, that it's just a tear down and it's land value and you buy it for land value, well, you can buy that and it's okay that it's a tear down. But if you go in thinking you can go in and do all the renovations going to cost you X, and you get in there and you realize it's more expensive, you just had a bad assumption. So I think that going in on the buy side is where you really got to make sure that you're conservative. And if you do that right, you'll be able to weather a lot of the storms.
That's right. So in other words, like when we underwrote this deal, we actually assumed a higher interest rate than the current treasuries. This was back a few weeks ago. Treasuries have gone down, but we kept that number in there. The deal still pencils. We like the deal at that higher rate. And I think about our Strawberry Station deal, the most recent deal we closed in Charleston. It was good timing because treasuries were fluctuating. They dipped. We locked in, and about a week later, they jumped by 60 basis points. So I mean, that could have potentially cost the deal a decent chunk of change. But, so it is about, watching the treasuries on a daily basis, working directly with our lender. And we'll actually have a point on that because that's the sixth lesson, having strong lender relationships. So we'll get there in a minute. But, when you have that level of trust and the lender calls you and says, hey, I'd recommend you lock, and you have a lot of trust with that lender, you listen. And in that context, the deal would have still worked at that higher rate, but we put a lot of, let's just say we added some returns to our investors by locking when we did, right? So having that higher rate in your underwriting, even based on where the treasuries are at today, is just what we're talking about when we say conservative underwriting, right? And if the deal works with all those conservative assumptions, it's a green light. If it doesn't, then take a big step back.
If you do all the right steps, there's a lot of ways that you can be conservative in your underwriting, and then you get a bunch of wins along the way. And I'll tell you, getting those wins along the way, when they start stacking up, that's how you're able to, if you do have a 20% projected return, how you can easily hit a 25-30% projected annual return in your deals by getting a few wins along the way and being conservative up front.
That's right. I think, you mentioned the 5-person investor committee we have, all senior leaders. And that's really the power there because, a big risk in real estate investing is, you haven't done a deal in a little while and you start going, oh, we got to do another deal. We got to do another deal. And so emotions can get involved, right? And so, when you have 5 people that all have different backgrounds, different behavioral styles, sort of different views on life. So, nobody's pessimistic necessarily, but we do have some kind of more conservative, maybe a little bit more, I guess, maybe
Paranoid.
pragmatic. Yeah,
Yeah.
maybe paranoid.
But hey,
um,
listen, you know what, John? Listen, as I've become more seasoned in business,
yeah,
I've definitely I've definitely become more paranoid in regards to making decisions in regards to
yeah,
what's the potential downside here. And I
yeah,
think that's actually a good thing. The more that I start studying the real business gurus, I actually heard Patrick Bet David say this one time. He says, I'm 51% optimism and 49% paranoia. He's
yeah, yeah,
like, as I
yeah,
become more seasoned. So I do think that there's that element of like, okay, what if? What if
yeah.
this isn't as good? And
No,
actually,
definitely.
there's one book that was really, I just finished off this thought because it's really good. This guy, he wrote The Road Less Stupid, Keith Cunningham.
Oh yeah, Keith Cunningham. That's
Yeah,
right.
The Road Less Stupid. And he said something really smart. He goes, whenever you go into an investment, he says, ask 3 questions. He says, what's the upside? That's the first question. Second is, what's the downside? And the third, he's like, this is the good one. He's like, can I live with the downside?
Yeah,
Can I live with the downside? And he's like, if you do those 3 questions there, it actually, like, it allows you to make more wise decisions. So that loops around to the the paranoia when you're making decisions. So sorry, John, I went down a tangent.
No, you're right though.
Going.
It's funny,
Yeah.
Mark Spain, my old business partner. He a healthy amount of paranoia is good, right? You know, looking around corners, trying to figure
Yeah.
out like what could go wrong in the plan, what competitors may come into the market, right? So for us, like, you know, we were doing a guaranteed offer program, and then Open Door showed up. For Canadian listeners who don't know Open Door, they were buying homes for cash online. You put in your information, they send you a cash offer. So we knew that was coming 2 years before they showed up in Atlanta, because we were paranoid and we were paying attention. We heard about them. They were in Arizona. We're like, if these guys come to Atlanta, it's going to create a challenge for us. And so we were so paranoid that when they finally showed up, we already had plans in place. And by the way, we ended up joining forces with them, right? So it all kind of shook out. But had we just been kind of like, you know, optimistic, everything's great, you know, we could have gotten caught flat-footed there. And so paranoia, it's a balance. I like that 51% optimism, 49. I haven't heard that before, but 49% paranoid. I think that's probably the right balance. And our team brings that, and we all have a unique way of looking at it. You know, our acquisition guy, Joe, right? Like, he's hyper focused on, you know, the details of the pro forma. We bring in Georgia, the asset manager, who has just 20 years of experience, so she can really talk through the rent growth and the business plan. You and I bring our expertise. You know, I tend to focus on the submarket and the area and all those factors. Your whole thing is the holistic view. And then we bring in Madison from the financial perspective. And she's probably the little more paranoid of the group. And so she's the one who's going, I don't know about that one, guys, or aren't we getting a little aggressive here with our exit cap rate? And so, you know, we touched on this on a previous episode, but it's, you know, probably 60 to 80 hours of conversations, model reviews, back and forth, research before we even tour an asset to see if it's a fit for us, right? And so a lot of time, effort, and energy goes into this. And the fifth reason, kind of shifting gears here, Mark, is, you know, really strong property management, but more importantly, even strong asset oversight within the organization. And so I think back when we first started, you know, our first hire was an analyst. Madison was already kind of on the team when I joined because she came over from your other company. So we already had our financial person in place. But the first hire we went out outside of Madison was bringing in an analyst. The second was an asset manager. And what was interesting is we had a couple of deals. You mentioned one that we had kind of brought some investment to. You have some personal assets. And so we said, gosh, let's go ahead and hire the person. There's plenty that they can focus on over here. But when we get our first opportunity, we already have that person in place before we acquire the deal. So they're having a say into the business plan. They're putting their stamp on everything. It was the smartest decision we've ever made, because Georgia just gets this stuff. And so, you know, she can go out and hold those property managers accountable. Because what I'll tell you, Mark, and I know you've had many different property management companies you've worked with, you can go to the best property management company in your market. They have the most solid reviews and give you all the references in the world. You could love them. But if the on-site team that they bring in isn't good, or they're just okay, your deal will suffer for it. And so having a strong property management team with strong oversight within the organization to hold that team accountable is so critical to success. You know, the fastest way to lose money during a downturn is poor operations. You know, at the end of the day, you can be successful in any market. You know, it's just, how do you adjust your strategy to deal with the things that are coming up because of that market, right? So battle tested property managers that have experience in that market. We have weekly calls with the property management team. Scheduled meeting occurs at the same time every week. It's the same cadence in the meeting, same things discussed. We even do daily huddles with the property management on-site team. So George is checking in with the leasing team at each site, checking what's their number one priority for the day, their metrics, right? Typically around, you know, leasing, right? So leads coming in and how are those leads being converted? And then the number one priority for the day. So no different than the huddles we do here at Faris Capital, but at the property level. And, you know, it's all about that, because that responsiveness, we find out about things in the moment. We even take it a step further where you and I get copies of every resident review and survey that comes through. So we're hearing straight from the residents about their experience. But it's really about protecting our net operating income, because with a weak team, you know, this is an interesting statistic, Mark, but I was actually at an event. It was a tech company that was sponsoring it, and they had a lot of data. It's one of the big property management software companies, so they work with like thousands of operators. And so part of their system, they actually track the inbound leads that the properties would receive. So a phone call coming into the property, it dials through their system, so it's logged. So the leads logged. It's easy for the property manager to follow up. Typical CRM structure. What they found is that over 60% of the phone calls that an average apartment building would receive would not be responded to within 24 hours. In some cases, never responded to at all. And so simple things like that, right? If you just miss that, right, all of a sudden your occupancy dips to 89% instead of 97%. So having those systems in place, and so we're monitoring that. I would say I don't really love the word, but we are absolutely micromanaging these property managers. Now we do it with love. We come alongside them. How can we support you? But we inspect what we expect, as Ronald Reagan would say, right? And make sure that all those numbers and all those tasks are being completed. So without that strong property management team in place, your deal will suffer, particularly in a downturn.
Well, if you think about it, if you are a resident, you're living in a community, and the on-site property manager is rude, is not fixing your defective sink that keeps on dripping, your toilet keeps on leaking, the light's no longer working, and you're there and you're in an apartment, and then your renewal comes up and all that stuff's not done. And remember, the property manager on site is rude. Okay. So that's just adding salt to a wound.
That's right.
And then the renewal comes up, and all of a sudden you have a $400 lift or a $300 increase because we've gone in, and the operator comes in and they start raising rents. What do you think that resident's going to say to that?
Yeah.
Do you think
Tell you
that
to
they're
pound
gonna,
sand.
"Oh, yeah, sure, I'll do that, and you're treating me like crap, and I'm gonna sign this renewal?" No. The number one thing is, if they're happy, if they're gonna take that renewal and say, "Yeah, I'm gonna pay that extra amount," or, "Screw you guys, I'm moving out." And I
Yeah.
might skip, and we call those skips. So they left town, and they didn't make any more of their payments,
Yeah.
and so they skipped. And so that's where, if you just think, like, if you are a resident, how do you want to feel when the renewal comes? Because the number one indicator if a property does well is if you can retain your existing residents, and if you can have those residents pay the higher increase in rent on the renewals. And if you can do that, if you can keep a high amount of retaining, and then if you can track new people in at the same time, your occupancy stays high, but your net operating income goes up. Now, if you have people constantly churning out, then your occupancy is going to go down and your renewals won't be as high because nobody's going to agree to pay those higher rents.
Yeah.
So this goes back to exactly what you said, that it's huge. The property management and how you oversee that property is such a massive part. And John, this is highly overlooked because when we go out to other assets, we see how they're being managed. And we have feedback from residents that come from other communities that tell us how they're being looked after. And so the number one thing is, if the property manager is friendly, they take ownership of the community, and they get things done quickly for maintenance requests and not let things slide. And if you do that on the renewals and they feel like they're part of the community, they're going to want to stay. And that's one of our biggest differentiating factors here, John. What we do so well is, within the first 4 weeks, we go in and we change how they're feeling about the community by going in and changing out the property manager to somebody friendly, doing the exterior landscaping. We add amenities, we give signage, and then we go in and we have our core values, our mission statement, and then we have our guarantees that are all encompassing. We do a new leasing center, new model suite, and new landscaping, and we change the overall community. And people are like, "Oh, geez, these guys mean business." And you, like, in a downturn, if the market is going down and all of a sudden you have a resident experiencing this, you change the way they feel. And when it comes time to the renewal, we've seen now that the increase in those renewal rates are much higher than if we just go in there and just treat them like a number. And
Mm.
the likelihood of them signing that renewal goes down drastically. And it makes common sense. Like, when you think about it, if I'm a resident, how am I going to feel if you don't do A, B, and C? And so
That's
that's
right.
where it goes back to the property management side of it is it's more important than ever in an economic downturn.
That's right. Which kind of dovetails nicely into number six, which is having strong relationships with lenders and your partners, right? So with lenders, you want to make sure you have one of the best lenders, great communication. I touched on this earlier, but that will call you when the treasury's at the right spot. You need to lock your rate in today, and you can trust that because they've been around the block and they know how this stuff works. Um, one thing I learned, kind of at Mark Spain Real Estate, my prior company, Peter Drucker sort of talked about this, but like single sourcing your vendors, right? So doing a lot of business with certain vendors. And so in residential real estate, what that looked like, we put all of our closings in Atlanta with this group, Weissman Law. And they were one of the best. In fact, the guy, Seth Weissman, the principal there, represented the Georgia Association of Realtors. So there's just a lot of reasons we went with this group: professional, great closing experience, all that stuff. But at the end of the day, by putting all of our closings with that particular attorney, if there was an issue with the loan on Friday at 3 p.m. and the closing needs to get punched, back to 7 p.m., if I just am closing one deal with that attorney, you better believe they're already at happy hour, at 5 p.m. But with Weissman Law, I call them up and say, hey, we need a favor. Can we get this closed at 7 and get this done for our client? And they're going to say, absolutely, because we do so much business together. And so in an economic downturn, imagine you're doing business with 20 different contractors and you need to renegotiate your contract, right? Now you got 20 different negotiations, but you're not doing enough business with any of them to make it worth their while to do any favors for you. But when you go with one vendor and you source that vendor and you've done a lot of due diligence to make sure they're the best, and there's an economic downturn, you go to them and say, hey, we're going to have to renegotiate here, but they've got all your business, they're going to be willing to do that, right? And just step up when there's an emergency. Come in on a Sunday if there's something going on with one of our HVAC systems and we need emergency work done. So it's really important. And I think for us, like, this is a great example, but, because we have to go through an approval process in Canada for our Canadian investors, having attorneys that can turn things around quickly, right? So all these things add up. And so when you do a lot of business with few vendors, and I hate to say it, but it's almost like you have a certain amount of power, right? It's like you're able to negotiate. Now, we don't take advantage of it. We're not rude or ugly. We don't lord over them. Oh, if you do this, we're going to take your business away. It's just more of it's mutually beneficial for both groups because we do a lot of business together. And so we'll come together in times of challenge or strife. And when times are great, we're still negotiating hard and getting the best possible deal. But it's just a smart way to do business that I found. Try to do business with fewer vendors, treat them really well, and push them to be as excellent. And that, they honor our values just the same as we do, right? That's another important factor. So aligning with vendors that share a similar ethic on how they do business and how they treat people. So I would say, those are the 6 reasons that if you're thinking about getting into investing or you're already in investing, apply these lessons to protect yourself during a downturn.
Yeah. No, they're powerful to remember always.
That's right. Yeah,
Not
that's right.
just when you see the downturn already happen, but really at a market where you're seeing everything looking good. You want to be able to say, hey, listen, we know that recessionary markets are not if, but when. We
That's
know
right.
that real estate goes through market cycles always. So if you always just have this mindset to be able to think like this and operate this way, then, you're always looked after. But it's
Yep.
when you start kind of pushing the lines and, like, oh, we don't need the cash flow on this deal. And, oh, let's bring our reserves down. We don't really need that. Let's thin that
Yeah.
out a little bit more. And, when you start thinking like that and you start pushing the envelope, uh, we'll just say you're asking for it.
That's
And,
right.
and that's where for us, it's like, that's the beauty of having we'll call it the council, making decisions there on these deals and how we're structuring, because we call each other out and we say, hey, listen, this is something we got to really watch out for. And, we'll listen to each other and then make a final decision from there.
That's right. It's about having systems, right? And, you have to have a certain amount of flexibility, but when you have golden rules or you have, like these 6 things that we don't do or we always do, it just gives you a good framework for better decision making at the end of the day. One of our values is to make wise choices. So having these frameworks ensures that we do that.
Yeah, right on. So, a few quick questions here that passive investors, if you're going into a deal, these are really good questions to ask. And so, John, we got the first one here. Is the debt fixed or floating? So this is a really good one. It's like, is it fixed or floating? That's, you can ask that. Does the deal still work if rents don't go up for 2 years? So what does that actually look like? What reserves are in place? What's the break even occupancy? And what that is say if the, we'll say, occupancy drops from say 95% to 85% to 80%, where's the break even occupancy? Where do you break even? Where you stop cash flowing? And so it's good to know that. And so that's where, if you're, from like 85 down to like 65% is kind of the range, that break even occupancy. As you get higher, it's a little more risky. As you start to get lower, you have more, we'll say, margin for error when it comes to the break even occupancy.
That's right. Yeah, so just some key insights, right? Predictable cash flow, fixed rate debt, conservative underwriting will help protect you in good markets or bad. It's really your safety net. Cash reserve, strong property management are critical to create staying power. And, protecting isn't really about fear, it's about building something that lasts. And so, follow these rules and you'll protect yourself in any market.
Yeah, right on. So, guys, if you are interested in investing in real estate, you'd like to partner with us, or you're just looking for a good deal, go to fulloutinvesting.com and you'll find our 10-step full out investing process. You'll also see a sample deal in there as well. And you can book a one-on-one call with John or myself to be able to better understand the real estate market. If there's any real estate questions, we work with accredited investors. So accredited investors is, you either make 200,000 in individual income or 300,000 as household income, or you have $1 million in investable assets outside your principal residence. So if you are a accredited investor, you'd like to book a call, you'd like to learn more about real estate or potentially partner with us, go to fulloutinvesting.com and find out more. Thanks for listening, guys. If you enjoyed this show, please subscribe and share it with other high net worth investors that you think will benefit from it. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.